In exactly 6 minutes, you are going to possess a complete, personalized system for managing your money. By following the steps in this video, you will build a framework capable of replacing the chaos of daily spending with a reliable structure for wealth. To build this framework, you need to gather your raw materials. Pause and pull up these 3 things: your total after-tax monthly income, last month's bank statements, and a digital spreadsheet or notepad. We all approach money differently. You might naturally operate as a spender who lives in the moment, a balancer who struggles with indecision, a highly cautious saver, or a risk-taking investor. Applying this mathematical blueprint provides a specific system to manage your income, regardless of your past spending history. This graphic shows the 50-30-20 rule. Allocate your after-tax income, 50% to needs, 30% to wants, 20% to savings. Look at last month's statement and sort. Housing and groceries go into the needs bucket. Dining out drops into the wants bucket. If you are like most people, you will immediately notice a problem. Your needs category will likely exceed that 50% threshold. To shrink your needs bucket back down to 50%, you have to execute specific reductions. Call your cell phone and home internet providers to negotiate a lower retention rate. At the grocery store, use per-unit pricing, checking the cost per ounce or per item, to ensure you are buying the absolute cheapest staple products. Scraping these margins away from your daily expenses and funneling those dollars directly into your 20% savings bucket stops the financial bleed. This creates the surplus capital you need to start growing your net worth. This timeline structures the 20% you save. Divide your planning into short-term goals under 1 year, medium-term goals 1 to 5 years, and long-term goals over 5 years. Your goals must be smart, specific, measurable, achievable, realistic, time-bound. Your very first short-term SMART goal is building an emergency reserve. You need to calculate the exact cost of 3 to 6 months of bare minimum living expenses and stockpile that amount. To guarantee you hit this number, remove your own willpower from the equation. Set up an automatic bank transfer on the exact day you get paid. That portion of your 20% bypasses your checking account and routes directly into a dedicated savings account. This automated reserve acts as a firewall. Medical emergencies and unexpected layoffs happen. With a fully funded safety net, you absorb the impact without ever derailing your long-term wealth plan. Step 3 deals with debt. Healthy debt, like a mortgage, increases your future value. Toxic debt, like credit cards, drains your wealth through high APRs. To attack this, list every toxic debt balance alongside its specific interest rate and minimum payment. You have 2 mathematical strategies to choose from. The high rate approach, or the avalanche, targets the debt with the highest interest rate first, saving you the most money over time. The snowball approach targets the smallest total balance first, giving you quick psychological victories. Whichever path you choose, the execution is the same. Continue paying the bare minimum on all your accounts to maintain your credit score, but funnel every extra dollar from your newly balanced budget directly into your priority target until it hits 0. Aggressively paying down high APR toxic debt provides a guaranteed return on investment, freeing up the cash flow necessary for the final wealth-building step. With your baseline secure, you must move from defense to offense. Saving means keeping money in a highly liquid account just to protect it. Investing means trading that immediate access and accepting calculated risk in exchange for compounding long-term growth. This chart shows the power of compound interest. A person investing $25 a month over 40 years will retire with significantly more money than someone who waits 10 years and invests double that amount. Starting early with less always beats starting late with more. To safely invest, follow this 5-step matrix. Step 1 and Step 2 are prerequisites you have already finished: locking in your 50-30-20 budget and maxing out your emergency fund. Do not put a single dollar into the market until your safety net is full. Step 3 is aligning your capital with your SMART goals. Only expose money to market risk if you do not plan to touch it for at least 5 to 10 years. This graphic illustrates Step 4, asset diversification. You protect your capital by spreading it across different risk tiers. You allocate portions into low-risk bonds, moderate-risk index funds like the S&P 500, and a small percentage into high-risk single stocks. Step 5 is regular maintenance. As you age and your timeline shrinks, your risk tolerance naturally decreases. You must review your portfolio annually and adjust the balance to protect the wealth you have built. The automated compounding of diversified assets over decades generates the long-term wealth that speculative stock picks often fail to replicate. You now have the complete blueprint. You lock in a sustainable budget. You automate an emergency reserve. You eliminate toxic high-interest debt. Finally, you funnel your excess capital into a diversified compounding investment portfolio. Because this system relies on automated rules and mathematics, it replaces emotional stress with a predictable framework for your daily financial decisions. Now it is time to build it. Pause this video, pull out last month's bank statement, and execute your 50-30-20 audit right now. A blueprint is simply information. Building your financial future requires the immediate execution of your first audit.